Okay, we're going to continue on with this subject in chapter 15 of talking about uh, investments in debt securities. But let me back up a little bit to where we were. Okay, just a little refresher of things that we've gone over. The first thing we talked about were debt securities that were classified as trading securities. Okay, these are, of course, debt investments, but they are actively managed for profit. Again, picture people trading these, buying and selling these on a weekly basis. Because they are so actively traded, we always classify these as current assets. And we do report the portfolio at fair value, as we had discussed. And that unrealized gain from the change in fair value, we report that on the income statement. Again, I'm reviewing. Now, if we go forward to the debt securities as held to maturity, or HTM, these are debt securities that, what do you know, we're going to hold those until maturity. Now, we report those as either non-current or current, just depending on what our intent is. If our intent is to sell them within the year, they're current. If not, then they're long-term or non-current. Now, the key here is that we do not adjust held to maturity debt instruments to fair value at year end or at period end. Once again, we do not know, there's no fair value adjustment to the portfolio for debt investments that are held to maturity. Okay? And we'll summarize this at the end of the video. Now, what I want to talk about are debt securities, we're still in debt, that are classified as available for sale, or sometimes we say AFS. Okay? Now, these are, I love this little definition here. Debt investments that are available for sale are those that are not classified as trading or held to maturity, the previous two categories. And here, I'm going to make it a little easier for you. I'm always going to tell you with the debt investments if they are classified as trading, or rather held to maturity, or rather available for sale. Okay? I'll always tell you that. Now, once again, these can be current or long-term depending on our intent. If our intent is to sell within 1 year, it's current or short-term. If not, it's non-current or long-term. Now, we do, like with trading securities, we do value these at fair value. Yes. However, it differs a little bit from the trading securities in that the unrealized gain or loss is not reported on the income statement, but rather in the equity section of the balance sheet. Okay? It's going to all look similar, except it is not on the income statement, that unrealized gain or loss. It is in the equity section of the balance sheet. Okay, so let's take a look. Okay, let's say that we are a Mitsu company, okay, and that we had no prior investments. This must be our first year of operation, or maybe we just had never bought investments before. But in the current period, we acquired 2 available for sale, or AFS securities, as shown below. Now, we're not showing the journal entries for that, by the way. But they do want us to look at this. At December 31, 2019, we have to adjust to fair value as shown. Okay, we see, and again, we're going to always analyze this on a portfolio basis. We're not going to adjust each individual bond, but rather the entire portfolio all together. So the total cost of our debt securities and available for sale is $73,000. The total fair value, which is more of a market value related a measurement for the portfolio is 74550. That means we have an unrealized gain of 1550. Now, it's unrealized. Once again, it is unrealized because we are not actually realizing this from a sale. We are not making a sale. on December 31st of 19. This is just an adjustment. This is an AJE that we make. Okay, so that is why we say unrealized gain. Now, we still debit fair value adjustment for available for sale. That's similar to what we did for trading. But now we credit unrealized gain, but we need to make sure we realize that that does not go to the income statement, but rather the equity section of the balance sheet. Okay? So the way that would look is this is a partial balance sheet. This entire thing is a balance sheet. The fair value adjustment that we add, since we're adding it, it is called an adjunct asset. Okay, an adjunct asset with a debit balance. And then in the equity section, and again, we're in the balance sheet, we are going to add the unrealized gain on available for sale securities. Okay, so since this is not on the income statement, but rather in the equity section of the balance sheet, this is a permanent account. That is a permanent account. It is not going to zero out during the closing process at year end. And that's important for us to realize here in the next slide. Because what we're going to do in this next slide is we're going to extend our example, and we're going to assume at December 31st of 2020, this is the second year. Now when we analyze our portfolio of long-term available for sale securities, we see that it has a total cost of $81,000 and an $82,000 fair value. Now this is at the end of 2020. Let me go back a slide or two. This is at the end of year 2019. Okay, and we can see that the total cost and the total fair value were these, and there was an unrealized gain, a fair value adjustment that we booked of 1550. Now in 2020, when we analyze the difference between the cost and the fair value is $1,000 and only $1,000 above cost. So basically what I'm saying is this: after we made, well, let me go over here. After we're looking at the fair value adjustment, after we made that entry at the end of 19, that fair value adjustment had a debit balance of 1550. Now we're looking again at the portfolio in 2020, and what we're saying is the difference between these two numbers now is 1,000. So what it should have at 2020 is a $1,000 balance. So what do we have to do to bring this beginning balance to the desired ending balance, or the needed ending balance? Well, we have to credit fair value adjustment for 550. And it's basically the same analysis with this unrealized gain, because it is in the equity section of the balance sheet. It is not zeroed out. This number, it remains there. It's permanent. So we have to adjust it, the unrealized gain, by debiting it. And that brings us to our desired 1,000. Now, you might ask, well, why aren't we debiting unrealized loss? Well, the reason is because right now it shows a gain of 1550. We want it to show an unrealized gain of only 1,000. So we don't want to leave a gain on there and create a loss. No, we're just going to reduce the gain that is on there. Now, if there were no gain on there, then yes, we would debit unrealized loss. But since there's a permanent account called unrealized gain that's in the equity section of the balance sheet, we are simply reducing it. So the unrealized gain, it still is an unrealized gain, will show up of $1,000. Okay, that's when you extend it on beyond just the 1 year. Let me summarize. Okay, these are all debt investments. Okay, we have talked about 3 classifications. The first thing we talked about was trading, and we said we always classify these as current. Do we report these at fair value? Do we make that adjustment? Yes. And that unrealized gain or loss is reported on the income statement. Then we talked about held to maturity debt investments. Those can be current or long term, again, depending on if we intend to sell those within the year. But we do not adjust those to fair value. We simply don't. Then lastly, we just talked about debt investments that are available for sale. Again, those can be classified as current or long term depending on our intent. Do we report those at fair value? Yes. Yes, we do. However, the unrealized gain or loss does not go to the income statement for available for sale, but rather to the equity section of the balance sheet. This should probably be something that you memorize and commit to memory, okay? Because this is kind of necessary information to do this section in regards to debt investments in Chapter 15. Thank you.